When you look at the report published last night, LVMH very much is a bellwether of the sector. It's the world's largest luxury group. So the analysts were really keen to look at whether it seemed that the Chinese consumer sentiment was starting to be affected by the trade war talks between the US and China. And so far, the LVMH results seem to have echoing the Hermès result that I published last week, that they seem resilient. Up until now. The first half recurring profit was up 28% to 4.65 billion euros, and that was led by the fashion and leather goods division, which is the profit machine of LVMH, and the sales were up 13% just for the Q2. However, if you look at the regions, and that's why it's interesting, Asia, in Q2, revenue growth, excluding Japan, dropped to 15% in Q2. So that was down from 21% in Q1. So of course, it's still great numbers, but it is slowing down. So there was this note of caution from Monsieur Arnault in the release saying that despite buoyant global demand, monetary and geopolitical uncertainties remain. And the CFO himself echoed that in the analyst call last night, saying that the trends that we've seen in the first half of the year cannot be extrapolated for the second half, and that we should be cautious for the rest of the year.
Henry,
go on.
I was just going to ask, why do I have to pay only 21 to 23 times for a company of this quality with growth, and yet I have to pay 19 to 21 times for consumer staples with zilch growth?
I think it's a very, very reasonable question, and I'm struggle to coherently argue against that.
Sorry.
Yeah.
No, but I mean, it just seems incredible. Consumer staples struggling at literally 0 to 4% growth parameters. Yeah. That is the wide range. These companies, and we're worried about them dropping to 15% growth. And of course, in China, if you extrapolated that fall from 21 to 15, then you're going to fall quite precipitously. But even so, I suppose you get a wilder ride, but you're not paying a massive premium for those extra growth potentials.
Absolutely agree. And I think you see consumer staples, to some extent, they're also voting with their feet. I mean, big deals in the space. I think they probably look at their current portfolio and don't potentially like what they see with regards to organic growth, so they're really having to put the foot to the floor with regards to M&A, and that clearly takes a toll on the balance sheet. So, yeah, I think you're right to make that observation around the relative valuation. Also, I back it up with the relative balance sheet strength. So I think there's reasons to talk against staples further, really.
Burberry made headlines for the wrong reasons last week, I think, when it was revealed that they'd burnt all this unsold merchandise. I mean, tens of millions up in smoke. Do you own a Burberry? Do you have anything in the sector that you're attracted to?
No, I mean, there have been chances to own Burberry for us in the last probably 2 to 3 years. The shares, on concerns around organic growth probably got below £10. We're now in the higher teens here. Burberry's always had a fantastic balance sheet, never felt the need to do a deal, so we've always had that balance sheet strength to hang our hats on, and then also their shareholder returns also as a result be very good. Right here, right now, as I say, as it gets into the sort of 20s in valuation terms on PEs, just looks a little bit too expensive for us. But we've got nothing sort of institutionally wrong against Burberry, just a little bit on valuation. We'd want to be a little bit keener on valuation here before we revisit it.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.